After Monday's tech sell-off, you may be wondering about the differences between the performance of the S&P 500 market cap weighted index and the equal weight index. And if you're not totally sure why they're different, not to worry, our own Jared Blikre is here to break it all down. Hey, Jared.
Hey, Brad, let's take a look at the Wi-Fi Interactive. I'm going to show you what the concern is about. And this is a mega cap. The Mag 7 performance over the last 10 years, these are some big numbers. NVIDIA up almost 25,000, Microsoft up 1,000, and the list goes on. Tesla up 2,800. But why do we care so much? It's because there are concerns that when the market becomes too concentrated, one of these people or one of all of the, or some of these names stumble, well, then we have a major market sell-off on hand and there's nothing to support it. But in order to really break this down, we need to get into some definitions here. So I'm going to start out with market capitalization. It's pretty simple. You only need two numbers to compute it. The share price, and for Apple, it's $240, times the shares outstanding. And for Apple, it's about 15 billion. You multiply those two numbers, you get about 3.61 trillion. Now we're talking about equal weight versus market cap weight. Let's start with equal weight. It's a very simple way to calculate an index. 500 stocks in the S&P 500, each one gets one vote. That is equal weighted. But then, if we want something that takes into consideration their value, weighting more, the larger stocks more and the smaller stocks less in the index, then we have market cap weighted. So these are the stocks that are weighted by the value of their total shares, and larger companies have more influence. However, this is actually not the gold standard. Since 2005, Standard & Poor's, which manages the S&P indexes, they have been weighting by float cap. So the float of a stock is actually the market cap minus shares that are locked up. And that might be because insiders have them, or maybe Warren Buffett owns them and he's pledged not to sell them for a long time. Nevertheless, float cap weighting is the standard. And if we take a look at the S&P 500 versus how much the Magnificent Seven is concentrated in the index, it's really interesting to see how this has evolved over time. We can go back all the way to 2013. That's when this begins. That's when we have all 7 stocks of these have IPO'd. Facebook was the last. And in white, we have the S&P 500. But we can see here in 2020, by the pandemic, the concentration shot up. The concentration of these Mag 7 stocks, they became much more important and more heavily weighted in the index. And they kind of didn't look back. We've seen some big drops here. That was the 2022 bear market. But then in the recovery, they just blasted off again and became a big part of the market, such that right now they're about 34% of the S&P 500. Now, does this matter for investors? Well, let me show you the S&P 500 equal weighted versus market cap weighted, and we can decide for ourselves. Let's start with a 10-year look at the S&P 500 equal weight versus the market cap weighted. We'll see if this populates here, and just try to maneuver this. Let's see. Well, it doesn't want to participate, but suffice to say that the equal weighted has lagged the performance of the market cap weighted by a large degree over this time. So simply buying the equal weight, and you can do this with, for instance, an ETF called RSP, that's it, RSP, you would have gotten 133% return over these 10 years versus 202% from the S&P 500. That's a pretty big difference. But what's interesting this year is that the Mag 7 have not counted quite as much. In fact, if you look at the equal weight, it's up 4% versus the regular weighting in the S&P 500, which is up 2.5%. It all gets back to diversification. If you're worried about too many stocks or too few stocks having influence over the market and having that outsized concentrated market, well, then you need to diversify. But the problem is with a market that's really led worldwide in the US, there aren't necessarily a lot of options. You can go into real estate, you can go into bonds, you can go into volatility, but you do need to think outside the box here. For most investors, a simple passive market approach, investing in the S&P 500 with dollar cost averaging, just adding whenever you have the money, is probably the best strategy for most investors.